gold going higher than anyone thinks possible because the goal of this administration is to shed the reserve currency. As crazy as that sounds, the term Triffin's dilemma says you will never have a positive trade surplus if you're the reserve currency. Vice President Vance has talked about it. The knucklehead, Jared Bernstein, one of the goofiest guys I've ever seen in my life, trying to explain how treasuries are created. He was the chief economist for the Biden administration. He did write a report called Dethrone King Dollar, which advocates for losing the reserve status. And there are mechanisms like the Genius Act, which says by January 1st of next year, anytime money moves, it will move via stablecoin. And the stablecoin has to be pegged to Treasury's 90-day maturity or less. The Clarity Act says that, well, that interest is not transferable to me or you, the holder of the stablecoin. The issuer keeps it. USA Tether, their CEO is a man named Bo Hines. That was Trump's crypto czar through August. What has Tether been doing with all of that interest? They have $14 billion in gold right now, which is the largest stockpile in the world outside of central banks. And what does rising gold do? Devalues the dollar. It's telling me that because of the deliveries, Kai, which never happened, mind you. Less than 1% of contracts on COMEX or LBMA really ever stood for delivery. Now it's a lot. Huge amounts. Record month after record month after record month after record month for the last 16 months since Trump won the election. It's telling me that gold and silver are finally beginning to slowly find real price discovery, which they've never been allowed to find, ever. Going all the way back to the London gold pool. Never found price discovery. It's starting to happen because delivery is overwhelming the ability to suppress with paper. That's just the bottom line. I think that's not true. I think that short-term caution should always be employed in a market that's moved up this fast. Long-term bullishness can coexist with that. And again, what I think even people like Ross, who far be it from me to argue with a man who's had serial success like him, but I believe this is different. This is not technical analysis. This is not what used to be. The dollar was always the beacon of trust, and the dollar isn't trusted anymore, nor are our institutions, nor is the system trusted. And I think gold and silver are reflecting that through delivery. The biggest, most well-informed players in the world continue to stand for delivery at a level no one has ever seen. And the retail public wouldn't know a gold coin if it fell on their foot. So no, this is far from a bubble. If this room was filled with people that have never been to a place like this, ever, then I might agree with that. But the retail public has no idea yet.
Like just looking around here, it feels like a lot of the old punters are back.
Yeah, I mean, there's more people here for sure.
Yeah,
but this isn't mainstream, dude. I mean, I've been doing this for so long, and I live in a country club of very well-heeled people, and maybe 5 or 6 of them have bought gold and silver from me. I don't talk about it. They know what I do, but there are very, very, very successful, wealthy people that are just who believe what Ross is, that this is oversold or overbought rather. This is a bubble. Look at the technicals, and I would say none of that matters in an environment that was once manipulated and is now trying to break free from that because the most well-informed traders in the world disagree. And I think the public hasn't caught on yet. So no, I think we're a long ways away. But a correction, sure, doesn't change my long-term bullishness view.
Market veterans often warn that rapid price increases signal bubbles. Short-term corrections are always possible, but this moment defies traditional technical analysis. What's driving today's gold and silver markets isn't retail euphoria, it's institutional conviction. The largest, most informed players are demanding delivery, not trading charts. Meanwhile, the general public remains largely disengaged. Precious metals ownership is still rare among wealthy households, let alone average investors. True bubbles are fueled by mass participation and emotional buying. What we're seeing instead is quiet accumulation by entities that understand systemic risk long before the crowd arrives.
You know, on the highest level, in December, We saw 65 million ounces or so delivered off the COMEX or onto the COMEX. Who's buying that? A mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who's buying 65 million ounces? But it's been between 40 and 60 plus million ounces every darn month for the last 15, 16 months. Who's doing that? And, you look at the LBMA, David Jensen, one of the best that there is, he says that London has 2 billion ounces in outstanding spot contracts that have standing behind it 140 million ounces. What could possibly go wrong if everyone stands for delivery? 2 billion into a window of 140 million. That's a problem. But when you look at what's happening here in the United States on a retail market, it's very, very, very confusing market. Largely because the price is moving up so fast the cost of maintaining positions is moving up so fast. Let me put it this way. We hedge every ounce we have. We will typically have between 2 and 3 million ounces of silver in our warehouse. To hedge one 5,000 ounce silver COMEX contract, you need to have over $40,000 in your margin account. On Christmas Day, it was 21,000. And so not only are the margin rates going higher, which shakes the weak hands off the tree. Let's look at December. They raised it twice in 2 weeks, before and after Christmas. So the day Christmas, 21,000, the next day 27,000 in your margin account. Now it's over 40. But if you are someone with a bunch of money in your margin account and you have a bunch of contracts, you're trying to take advantage of the silver run, and all of a sudden they raise the margins on you by 30% on the day after Christmas, and if you don't pay, we liquidate. Well, a lot of people are forced to liquidate to cover their margin on the other contracts or whatnot, which selling begets selling. Now in 2011, that killed the rally. That's what they did to stop the rally. They raised margin a bunch. This time, what happens? Oh, it's the largest delivery in the history of the COMEX for the December contract, because the people that are standing for delivery, Kai, they don't use margin. They don't care. It's a subsidy to them. Thank you very much, they say. Scoop it up and stand for delivery. So things are changing, but I will tell you, like refineries, they're not taking any business right now because it's taking them so long to purify and produce. And they have to hedge their position too. So if they have 30 million in work, it takes weeks to get it fully produced from scrap or junk silver or doré or whatever to the refined product. It takes a while, but the price is moving up so fast that their hedge book, so if you have 30 million, you have to sell 30 million on COMEX. So if the price of your 30 million in inventory drops by, $10, you're not out enough to put you out of business. So instead, you short the exact same amount. You remain market neutral. Problem is, silver's moving up so fast and the rate hikes are moving up that they're getting margin called. So the refiners aren't taking anything. The big companies like myself and even the bigger ones who try to hedge, if you have 3 million ounces and it costs 41,000 to hedge 5,000 ounces, you have to have millions and millions and millions of dollars in your margin account just to maintain a hedged position. It's a crazy environment right now. Kai, I've never seen anything like it, but to me, all I look at is the most well-informed traders. Since I started talking with you, it was the central banks, and now it's progressed to whoever the hell is doing it here in the United States at a level no one's ever seen before.
Behind the scenes, the physical metals infrastructure is under pressure. Massive monthly deliveries, tens of millions of ounces, raise a simple question: who is buying at this scale? Refiners, mints, and wholesalers face rising costs and logistical bottlenecks. Hedging inventory has become prohibitively expensive as margin requirements surge. In past bull markets, margin hikes crushed rallies by forcing leveraged traders to liquidate. This time, delivery demand is coming from buyers who don't rely on leverage at all. Margin increases don't deter them. They accelerate physical withdrawal from the system, tightening supply even further.
Look what the U.S. government did after all of these imports. What do? Oh, that's right. Silver's a critical mineral. Oh, that's right. We are now putting a floor underneath it. Within the next 90 days, a state-sponsored floor underneath all the critical minerals. Why? To incentivize domestic mining. If silver is found in a form called epithermal, like your skin is epidermis near the top, big deposits were found forever ago. So you got to dig further. Most of it comes from byproduct of copper, lead, and zinc. You got to dig further, look more. Well, the all-in sustaining cost at that level is probably $40. So if you put a price floor high enough underneath it, you will incentivize domestic mining. And now they just came out and are proposing a strategic stockpile. So you can see these things are happening, but the thing is that the mainstream doesn't get this, doesn't talk about it. You got to listen to people, conspiracy theorists like you and I, right? Or are we? Or are we maybe just seeing things a little bit more clearly than the masses?
I think we got the track record now to prove that
I
we're
think
maybe
we
not.
do. Well, on some things anyway. Ask our wives, they may tell you different. I always say be careful what you wish for. But really, to me, what it is, instead of the world burning, it's the dollar bills that we call money are burning. The paper currencies have the sustaining power of a melting ice cube. And so did gold and silver really go higher, or did the dollar that we call money really fall further? And I think that's what it is. When you're creating $1 trillion in debt every 100 days, and 1 trillion seconds ago was 31,688 years ago, when the world no longer trusts dollars, no longer trusts treasuries, no longer trusts our institutions, judicial system, electoral system, immigration system, all of these systems, then what is the incentive to hold treasuries and or to hold dollars? There's not. And that's why we're seeing de-dollarization. That's why we're seeing commodities usurping treasuries. That's why we're seeing the dollar lose purchasing power. The world is always burning somewhere, but not to the way that people would frame it at $5,000 gold or $100 silver.
Recent policy signals suggest governments are paying attention. Silver has been designated a critical mineral, opening the door to price floors and strategic stockpiles. These measures aim to secure domestic supply and incentivize mining, particularly as extraction costs rise with deeper, more complex deposits. Strategic stockpiling changes silver's role from a purely monetary asset to a national security resource. Yet these developments receive little mainstream coverage. Markets are adjusting before headlines catch up. When governments begin protecting supply chains, it often signals recognition of scarcity, not abundance.
It is anti-dollar system. It is the realization that money is gold and silver and everything else is just credit, as J.P. Morgan said. But yes, I think to a large degree it is at the highest level. There's a whole school of, to Ross Beattie's point, the counter to it. There's a whole school of investment theory called wave theory, right? Kondraty of Elliott wave, which is about the masses. The people here are the pimple on the elephant's ass. This is not the masses. The masses are out there. And Kondraty of an Elliott wave says it measures the emotions of the public, the herd, from, greed, which turns into exuberance, irrational exuberance, fear, panic. And we're long ways away from the fear side of it with pouring into metals with the public. We're a long way from that top on the retail level. They haven't even really started to run through the door yet. So up there, they see it, they're pre-positioning, but I don't think we're anywhere near that blow-off top because the public is really not participating. Well, the difference between us and Goldman Sachs is that we've been saying this forever, and they keep changing. It's like a moving target. Yeah, 2,000, no 2,400, no 3,000, no 3,100, no and they keep going higher and higher and higher. At some point, it would just be nice if they said we were wrong. And they have been wrong. And you look at the S&P 500 up under 20% in the midst of the greatest tech boom ever last year. Silver up 150, 7 times it. Gold up almost 80, 4 times it. Where are the advisors who said don't buy that stuff, it pays no interest? Where are they with the tail between their legs saying, I don't know, you live in Germany. I don't know if you remember Happy Days, the TV show. You remember that?
No, I don't.
There was a TV show, and for your older viewers, they'll remember it. And there was a guy called the Fonz, and he was this leather jacket, motorcycle. He was super cool, and he could never say I was wrong. He would say I was ruh-ruh-ruh, I was ruh-ruh. They can't say the ruh-ruh. They can't say they were wrong, and they have been. And the people who have separated themselves from the masses have been right. And this is why I think we all need to trust our gut and our intuition, because we're in uncharted waters, and that speaks, I think, far more clearly than a financial advisor who might have different interests or objectives than you, and maybe has been married to a school of ideology that stocks and mutual funds and bonds are the road to retirement, so they learn more and more about less and less till they know everything about nothing. But what do you know? The CIO, Chief Investment Officer of Morgan Stanley, what did he say? Well, that 60-40 stock bond platform that we've used for 50 years, it's broken. Sell half your bonds and put it into gold. So here at the highest level, which hasn't filtered down. I have an account at Morgan Stanley, and the broker is a good buddy of mine. He wouldn't know gold coin if it fell on his foot. I said, do you know your chief investment officer said sell half your bonds and put half of it into gold? And he said, no. But this is coming from the CIO. It's starting at the top, and the big money who positions before the plebes, they'll get it, but long after the big money's already sitting comfortably in their deck chair.
Gold and silver aren't rising in isolation. The purchasing power of fiat currencies is eroding. Trust in institutions, debt sustainability, and long-term fiscal discipline is weakening globally. Rapid debt expansion and persistent deficits undermine confidence in paper money. As de-dollarization accelerates, commodities increasingly replace government bonds as stores of value. The question isn't whether metals are becoming more expensive, it's whether currencies are becoming less credible. Historically, gold and silver reassert their role whenever confidence in financial systems falters. This cycle reflects a loss of faith, not speculative excess.
Gold going higher than anyone thinks possible because the goal of this administration is to shed the reserve currency. As crazy as that sounds, the term Triffin's dilemma says you will never have a positive trade surplus if you're the reserve currency. Vice President Vance has talked about it. The knucklehead, Jared Bernstein, one of the goofiest guys I've ever seen in my life, trying to explain how treasuries are created. He was the chief economist for the Biden administration. He did write a report called Dethrone King Dollar, which